And unfortunately, we've got almost 27 trillion in outstanding treasuries. That's 10 trillion since the pandemic shutdown. They've added 10 trillion. This is the problem right now, which is kind of frustrating to be a gold investor or a gold mining investor, but that is going to change as these treasuries are not, this treasury market is not going to be sustainable in the future.
Welcome back to Metals and Miners. I'm its founder and its host, Gary Boehm. We have an incredible discussion today that you do not want to miss, and you need to watch the whole way through. Today, we will dive deeper into the impacts of surging costs and declining production on gold miners. That, yes, the miners have more risk than the physical metal, but where will the future supply of the metal come from? What will ultimately cause the big move in the gold price? Why silver is the better value right now than the broader stock market? And that while investors continue to ignore energy metals in the mining industry, as the US stock market becomes more concentrated with the largest stocks, there will be a rotation back the other way as investors realize that they must protect their wealth as we hit the energy cliff. To discuss all of this and more, we're fortunate to have with us Steve StAngelo, founder of the SRS Rocco Report. Steve is an independent researcher who focuses on the metals, miners, and oil, and has written many, many articles sharing his research through the years across many platforms such as Zero Hedge, goldsilver.com, and several others. I am very much looking forward to this discussion. Steve, thank you so much for joining us today.
Gary, and thank you for inviting me. There's so much going on in the world, and it's the hardest thing to know is who to listen to and who not to. Yeah. When you can figure that one out, you can really understand better what's happening in the situation. So I do appreciate you allowing me to talk with you.
Yeah, thank you. All right, well, let's begin with gold. Steve, in your analysis, what has led to the gold rally that we've seen over the last few weeks, and is it sustainable?
That's the question that I don't think anybody has a good answer. But when you look at the fundamentals, Gary, it seems as if this is driven more by, they call it hot money, but it is commercial. It is speculative on the exchanges and over the counter. Because even though there's more central bank buying, to see this big increase in the gold price in just a very short period of time, I've seen these spikes over and over. So is this a sustainable rally? When you see the commercial net short position last week go up 48,000, and it's probably going to go up another 10, 15,000 this week. That means there's a lot more speculators coming in. And so I think this is more driven off the exchanges because right now there is no demand for retail bullion gold. And I'm not saying that's a big indicator, but there's just really no demand for retail bullion gold. So I think this is a short-term spike in the gold price.
So what does your analysis inform you about this bifurcation between the strong central bank diversification into gold while ETF demand, is continuing to weaken?
You bring up a good question because this is something I've been looking at. And if you look at the GLD, which is one of the major ETFs, if you look at institutional ownership, there was a bit of an increase in institutional buying during the Russian-Ukraine war. But since then, they've been flat. Institutions aren't buying and they're not selling. So who is selling the GLD? I think it's hedge funds. I think it's high net worth individuals and retail. Because why? What happened in mid-2022? The Fed started raising rates. So instead of putting your money in gold, which I believe you should be in, investors who don't understand the real value of holding on to gold, like hedge funds have moved into a lot of in the treasury market. So they're selling gold. They're moving into higher interest rate, kind of like the treasuries, money market accounts. And so I think this is what's happening. Even though central banks have been buying, they bought a little more, almost 1,100 tons in 2022. They bought about a little more than 1,000 tons in 23. January, they bought 39 tons. And if you go back to the fourth quarter of last year, the average a month was about 75 tons. So right now, they're half of what they were based on a monthly average. So they've cut down a little bit on January. We don't know February. We don't know yet what they're doing in March. But I think this bifurcation is due to what happened with the Ukraine war. And I think we're seeing central banks now not trusting what's happening with the SWIFT system. And now they're moving more into gold. But still, even though that's a lot of gold, we still had a net surplus in the gold market in 22 or 23. We had a net surplus that was fed into the over-counter market. So that's kind of the dynamics playing. And I do think we're going to see even more central bank buying in the years ahead.
Yeah. Yeah, I would agree with that. It's been reported that 80% of the people own zero gold, and the average gold ownership is less than 0.5 to 1%.
Right.
It's very small. It's substantially below the mean. From the standpoint of collateral, will you tell the audience why it is critically important to own gold?
Right now, I spoke at the Silver Symposium in the Caesar's Palace in October last year, and this is my basis, my analysis is really people don't understand what creates value. So when you've got the gold mining industry, their cost now to produce total cost is about 85%. So if it costs that much money to produce gold, which they're selling about 2,100 or higher, the U.S. Treasury can issue 2.4 trillion of brand new treasuries last year at zero cost. Now they have to service that cost, but Janet Yellen said they can just print that. And so when gold is competing with central banks that can print these supposed assets, I call them liabilities, at no cost, the demand for gold is dropping. And so that's why you're seeing retail and high net worth individuals, hedge funds, they're kind of moving out of gold because they want to earn their money to earn interest. You can't do that with gold. The problem is the higher all this money printing is impacting the gold miners. So collateral should be based upon energy consumption. And unfortunately, we've got almost 27 trillion in outstanding treasuries. That's 10 trillion since the pandemic shutdown. They've added 10 trillion. This is the problem right now, which is kind of frustrating to be a gold investor or a gold mining investor, but that is going to change as these treasuries this treasury market is not going to be sustainable in the future. And so that's when collateral is going to shift from US treasuries being the high form of collateral back to gold and even silver.
So you mentioned the word shift, and that's perfect. Steve, is gold and silver truly shifting from west to east? And if so, what does your research suggest is the impact of this, or what it will be in the coming years?
We saw a lot of gold buying by West last year, a lot more than the growth was much more than the East. Asia has always been strong. India and especially China have always been strong fundamental buyers of gold. But if you talk about increase, Germany was buying a lot of gold last year. The United States, the Americans were buying a lot of physical gold last year. What's changed is we're seeing more demand now in China due to the issues China is having with their economy and in their system. And so, but right now, I don't think it's switching. Right now, Western demand is dead. I would say that ETF and even retail bullion demand, but it's fickle. And I think it won't take long. Well, it will take some time, but that's going to come back around because where is most of the wealth? It's still in the West, even though Asia is growing. So I think Western demand may be slow now, but it's going to come back. And if you get strong Eastern demand, very strong Western demand, that's when I see much higher gold prices.
So which geopolitical players have an interest in keeping the price down? And for what reasons, and are they able to even sustain that indefinitely?
Well, actually, I'm not really one that adheres to the theory that the central banks or the commercial banks are keeping a lid on the gold price. I think rather they've trained the market to no one wants to buy gold and then if they have a lot of money, store it and pay to store it. People don't want to do that. What do they want to do? They want to see their money earn money. And the only way you can do that is in interest or in stocks, things that grow. Mm-hmm. And so I think what's happened is people are more interested in those kind of investments. That's why the psychology isn't in gold and silver. But when we get into trouble with energy, which is my analysis, you have to be in physical assets. So I think the East understands the problems that the West, especially the United States, is no one else can print. The US dollar is the reserve currency. When you can print these many treasuries and the market continues to absorb them right now, this is what the East is still competing with as well. Not only the gold and the gold miners and the silver miners, it's the East is competing with the US Treasury and the US government printing a lot of these treasuries just to keep the system going. So there's so many different details going on, Gary, but it is quite fascinating to see all these things change. But my analysis shows that the U.S. Treasury market, which is the foundation of the collateral in the world, that's going to get into trouble starting after 2025. And that's when people really need to be in physical assets.
Interesting. So, Steve, what will cause the big move in the gold price? Will it be that trouble in the bond market, in the debt market? Is it going to be something else?
I base my research on energy, and right now we're having a lot of problems with things due to energy. We look at what happened in Europe when the price of natural gas went up. It nearly destroyed the UK gilt market. People don't make that connection. Inflation got so high that it really destroyed the UK gilt market. So that didn't go away. They just papered that over. So right now, natural gas prices, energy prices fell. That's going to come back and go back the other way again. And so I believe energy constraints that we're facing is the factor that's going to start putting a lot of pressure on all this finance. And that includes U.S. treasuries, that includes the Japanese bonds, that includes the European, the ECB bonds. So yes, as time goes on, those assets get into more trouble. The metals look better and better. And so that's how I see it playing out over the years. But to me, after 2025, when things start to get interesting.
So it sounds like you're, and I don't want to put words in your mouth, but it sounds like you're telling folks that it's okay to be in this time frame of stacking, even though you're not collecting interest like you would in treasuries or whatnot, because there will come a day when there's going to be a reversal.
Yes. Before the pandemic, before the 2008 financial crisis in 2007, there was 4.5 trillion in outstanding treasuries. I just looked at February. There's 26.8 trillion. Wow. Why do we need an extra 20 trillion? We don't. That was used to fund our deficits. That's what it was. And then that became if you look at the increase in our annual deficits, the cumulative increase, and you look at the M2 money supply, they go up in hand. And so this is what's been going on and so you've got all these almost 27 trillion in outstanding treasuries. The problem is there's going to come a point when you can't have the market can't continue to absorb them. And when that happens, how are they going to settle 27 trillion? And that doesn't include the number I see. It's over 80 trillion in these central bank treasuries or bonds all over the world. This is the problem that just gets worse each year. And that's why the metals, that's why people should not be concerned about these up and downs in the metals. Even though gold hit a new high, there's no interest. That's funny. But I think we may see a correction in gold. People should continue to add to their metals because that's the real foundational asset to own in the future.
So I know you have a chart for this one. Overall gold production for one of the majors, Barrick Gold, has fallen to a 2-decade low. Other majors are in similar situations. Steve, will you speak into the production issue and what your research is saying?
Okay, let me share this this chart. And I just did an update. Can you see the chart?
Yes. Yep.
I just did an update on the top 6 gold miners. And it's amazing how quickly, I think the CEOs are quite surprised how quickly costs have gone up. Now there's cash costs, there's all-in sustaining costs, but I look at the total cost, and that is my adjusted net income, and also I go by the free cash flow. And right now, when you average the top 6, Barrick, Newmont, Agnico Eagle, Kinross, Anglo Gold and Gold Fields, their total cost for the year is $1,700 total cost. And this doesn't even include share dilution, that they've done massive share dilution since about 2000, in the last 10, 15 years. Now, Barrick production has continued to decline. It was over 6-7 million ounces 15 years ago. Now it's at a little bit more than 4. So why is my cost of production, I think, a better realistic cost? Because the all-in sustaining cost excludes expansionary or developmental capital. Well, Barrick has excluded billions of dollars of expansionary and developmental capital, and their production continues to decline. There's only one miner in that group that's increased production, and that's Agnico Eagle. But the rest of them, when they exclude their expansionary or development capital to make their all-in sustaining costs lower, it's kind of deceived the market that that's the real cost. But unfortunately, they're not growing production. Matter of fact, the top 6 had 21 million ounces in 2019. Now they got about 20 million. They haven't grown, but they keep excluding developmental and expansionary capital. So this is the issue. And I don't see, the thing is, a lot of people are frustrated with the gold miners because they've underperformed. They've underperformed, Gary, because the central banks can print treasuries at zero cost while the gold miners' costs are going up. And the gold price isn't going up high enough for them to make these margins. And so that's why we're seeing less interest. But I think that's going to turn around. That will turn around in the future. So I hope that explained my analysis on what's happening with gold and Barrick and the gold mining industry.
Yeah. So this may be redundant. I wanted to shift over to the gold miners right at that moment. Steve, you recently wrote that the surging costs, the Fed printing, the rising capex, the declining production, they're all impacting mining shares. When do you see this weight lifting off of them, and by what catalyst to free the mining shares to rise based on the higher price of the metal?
The oil prices can decline, and that can bring down costs. But I think what we don't realize, as I mentioned, CEOs like Newmont's CEO, and I've seen a lot of people really, Newmont really sold off. It's the largest producer. They merged with Newcrest, and they just announced they're going to sell 6 of their mines. Now, if you go back 4 years ago, Gary, those mines were making pretty good money. You should see the all-in sustaining cost, which isn't the total cost. These mines are getting like $1,700, $1,800, $2,000 all-in sustaining costs. So it's really more of it's what's happening with the cost push inflation due to all this central bank money printing. It's hitting the producer price index, is really impacting the miners. So when does it change? It changes when investors understand, even though they're moving into treasuries because they can earn a yield, the problem is that treasury sustainable if you get a longer bond, like a 10-year? Is that going to be settled? And if this becomes into question, we get some failed auctions. That's when we start seeing selling of treasuries, moving into gold. Gold goes up because that's a very stable market. And as the gold prices really have to go up. And then the miners you're going to see their share prices increase. And one last thing, the treasuries, the governments can print treasuries at zero cost. Guess where the collateral is going to come from? The gold miners. That's the real collateral. So when the market realizes it's not the U.S. Treasury providing collateral, they're providing debt, liabilities. It's the gold miners that are providing the real collateral. The market psychology doesn't realize it yet, Gary, but they will.
So it sounds like the trigger point that you're looking for is the auctions, the bond auctions.
I think part of it is going to be the bond auctions. I also think the U.S. government is going to have to understand that it's $1 trillion a year in interest expense.
Minimum.
Think about that. Do you know how much? Just think about this. They're going to have to pay $1 trillion in interest expense. The gold mining industry this year, if it produces 118 million ounces, and you multiply it by $2,000, that's like 300 billion. It's a third of the interest expense. And so this is part of the issue. We're going to see failed auctions in the future. And again, the energy constraints that are coming, which is the foundation of my analysis, it's going to put severe pressure on the sustainability of this highly leveraged finance. And treasuries are just part of that. There's a lot more other finance out there.
So, we've talked about these miners during the last major gold mining bull that culminated in the peak in 2011. Mining executive teams were spending basically like drunken sailors, and they lost the investors. The investors started dumping. Today, these executive teams have been cleaning up their balance sheets, trimming costs as best as they can, running lean as best as they can, buying back stock. Will their efforts matter?
Yes, it will. They didn't. Yeah, you look at Newmont, you look at Barrick in 2012 and 13. They were spending a lot of capital, and it turned out to be unfortunate. It was misplaced capital. Now, even though they're spending a little bit more on capital, they have to, because just to continue churning out this gold, it's a massive grinding of equipment. It's just very expensive to produce more gold as the ore grades continue to decline. And so I think this going forward, the gold miners are unloved right now. Even if you think the gold miners are in bad shape or unloved, the silver miners are worst. My analysis suggests it's $22 now. So it's worse for them because they're not making any money. At least the gold miners are still making money. Because, especially with gold at 2170 now, they're still making money with that 1700 cost of production. So I think their efforts are going to be rewarded, but that is when the market psychology understands what is true collateral. And right now they don't. They're still chasing yield. They're still chasing that 5%, but they put all that money in that. What happens if they can't get that money returned? That's one question they're not even considering. They just assume that treasury is always going to be there to sell, and it's not going to be unsustainable. And that's the problem with failed auctions in the future. No one is even thinking about that.
That's interesting. So while the miners certainly have more risk than the physical metal, we're all asking and wondering where the future supply will come from if it doesn't come from them. The miners are so unloved, like you've been saying. They're competing with the central banks who could print bonds and treasuries at zero cost, like you've been saying, while they're trying to make a profit, and their costs, their underlying costs are skyrocketing. Like you've said, the metal's actual collateral, since it's literal money. I mean, Steve, JP Morgan stated, gold is money, everything else is credit. The miners can literally print money. That they're the ones who can print money, not the treasury. Is your analysis pointing to the next bull run in metals and mining to be more similar to the 2015 and 2020 mini bull runs, or more like the 1970s and early 2000s major bull runs?
Both of those, and this is where I have charts showing this, the 1970s and the 2000 to 2011 bull markets, all based on the energy. The price of oil was $1.80 a barrel in 1970. By 1980, it was $36. Well, if you're home stake mining, and I've got the home stake mining annual reports, and you look at what it cost them to produce gold in 1970, it was $40 an ounce. That's the price, 42. It cost them $40 to produce gold.
Wow.
By 1980, their costs exploded, home stake mining. So now the gold price shot up to 850, but then it came back down. The gold and silver prices went up due to the inflation in the oil price. The same thing happened from 2000 to 2011. We went from $19 oil to over 100. Mm-hmm. And then the ore grades were declining as well. So going forward, even though costs are going to increase, and that's one of the reasons why the gold price will go up, the major factor is the problem with energy, and it's going to negatively impact finance. So what happens is you get investors out of finance and into gold and the miners. So, and then there's just not many miners. There's just not that much gold. there's 500 trillion in finance in the world, global economy. And that's even in the shadow banking system. So this is how more I see it. It's not really the costs going up to push the price of gold. That will happen, but it's the realization that I got to protect my wealth. We're heading to a world, well, I call it, you really can't build wealth in a declining or peak energy environment. You've got to protect it. You can't protect it in a treasury. You can't. That's a liability. You can only protect it in real assets. So that's how I see it playing out. It's a longer, but more fundamental and much more stronger. I can't put a value on the price, but I think we're going to see extremely high values for gold and silver, either in dollar terms or when you compare them to goods and services.
Yeah. Very interesting. So, Steve, I'm going to steer our discussion over to silver now. Silver's been in deficit for more than 4 years. That trend is expected to continue. It's expected to escalate for a number of reasons, including the lack of dedicated silver mines, increased solar, increased battery, and the electrification of everything, among other reasons. Do you see something big about to break for silver?
Silver is like the grandchild or the stepchild to gold. What happens with gold tends to happen with silver. It's a little bit differently now because central banks aren't buying silver. Some may have some, but they buy gold. So silver is kind of off the radar, but it's the issue with silver is there's not as much, there's just almost as much investment silver in the world as there's investment gold, about twice as much. I think it's 2.6 billion. If you add up all the central bank gold, all the private gold and the ETFs, 2.6 billion ounces. That's the estimate in investment gold. There's about 5 billion, maybe 6 billion in investment silver. That's ETF. That's held in vaults. That's also in private coins and bars. So when you figure there's only a 2-to-1 ratio of investment silver that in the market, when investors start switching and transitioning into protecting wealth, and that's the new paradigm we're heading to, then there's just not that much silver. So that's why I see silver is going to, I think, drastically outperform gold, even though gold is a central bank asset. There's just not that much silver to protect your wealth. So this is why the silver miners are struggling, but I think the silver miners are going to behave like the gold miners because they're also providing a high quality collateral. It just takes a lot less energy to produce silver. It's about 100 times less energy. So that's why the gold price is much more. You know, people say, well, Steve, why is the gold price, 70, 80 to 1? Well, you know what? 1,700 gold, 2,200 silver, the cost of production, you divide those two, what's the ratio? It's 80 to 1. That's the way the market is currently pricing the gold and silver, but it should be based upon how much is there. That's what it should be based. And it isn't doing that yet, but I see that transitioning in the future.
So recently BlackRock increased their
Yes.
PSLV shares to 25 million. So while silver sentiment is at a low, BlackRock continues to acquire the shares. Why are they doing that if silver is a dead asset going nowhere like we keep hearing?
I think slowly in the background, some institutions are continuing. Well, according to my analysis, they haven't really liquidated any of the GLD. The institutions haven't, and other hedge funds investors have. When it comes to silver, the SLV has seen outflows by institutions. Not a lot, more by high net worth hedge funds and retail investors. The only one we've seen growth, Gary, is the Sprott PSLV. And right now it's over 90 million shares that's held by institutions. BlackRock owns 10 million of those 90, they own 25 of those 90 million shares. So when we understand that's almost a quarter of all the PSLV, the thing you asked me is when did this things turn around? When you have very strong central bank demand, when you have a very strong retail bullion demand, when you have very strong ETF demand, when you have all those demands all come in all at the same time, that's when we're going to start seeing the price of these metals take off, because institutions, not just like investors, they're going to have to also protect their wealth. And right now they're doing it in treasuries and other financial assets. The same thing that's going to happen to Joe Bag of Donuts is going to happen to large institutions. So I actually see them transitioning into metals themselves as collateral. And there's just not that. I mean, the allocation of GLD and SLV, it's like 0.004% or 5% by these major institutions. They don't have really any of it. Even BlackRock, it's trillions. This PSLV stake is very little. So it wouldn't take much to see that increase.